Hello, everyone. Lovely to meet you all. Welcome to the Healthcare Home Loans webinar. Today, we are talking about clarity and confidence in financial years 25-26 and the lending landscape. Why we're here. So we're from Healthcare Home Loans, and we want to make sure that you're on the right path. Some of the questions that our clients come to us with when they see us in the hospitals or online or get our details from their friends is, hey, are we on the right rate? What's changed? What should I do next? What can I afford to buy in this market? What are my next steps? And
So everybody, the reason why we're doing this as well, just to interject, Carla and I will do this, we'll kind of play a bit of tennis with one another, is in the 25-26 tax year, the banks change their policies all the time. We're lucky to have our credit manager here, Marguerite, and she will tell you that the banks often change their policies. And what that practically means for you, little changes in words can have a big, big impact on your borrowing capacity, the rate that you pay, your loan to value ratio. And what we want to do today is, as Carla just said, give you some confidence around your rate, what you should do next if you are interested in getting into the market, and then how to go about getting started. Because I've had heaps of first home buyers, heaps of upsizers come to us and say, I want to buy a new house. What do I do? And I want to get into the market. How do I get started? So we're going to do our best to cover all of that. If you've got questions through the presentation, please leave them in the comments below to the side, wherever it is on your screen, and we'll help moderate all those questions.
all right. So what's actually changed in this recent financial year? There has been a few things around interest rate movements, key economic trends that have impacted the actual healthcare landscape, and then the policy shifts. So when we're talking about the interest rate movements, for a while there, everyone was concerned. Interest rates were going on the upward swing. We had 14 consecutive rate rises. And now what we're starting to see is there is a trajectory of a downward trend. We had the assumption at some point that rates were going to start to plunge downwards, but what we're starting to see is they're actually plateauing, they're not plunging. After last year's hikes, the RBA has signaled for a higher for longer stance. So we're not seeing the deep cuts, we're just seeing minor adjustments in the market, and buyers are starting to wait for those big drops to happen. So we're seeing that holding pattern happening. What we're also seeing is that there's a bit of a difference in the fixed versus the variable spread. So lenders are finally starting to price sharper fixed rates at the moment, which is really strong for us. It's still not where they were pre-COVID levels. However, some lenders are still offering short-term fixed specials, which are really worth discussing, because if you can get a cracker rate that's 5.15, 5.25% for a few years whilst we're waiting for the rates to come down, and that suits you, that's fantastic. But right now in the variable landscape, we're seeing rates between, the average rate is between about 5.5 to about 5.75. The impact on repayments right now. So we all wait for the RBA meeting, and we always wait to see, is it going to be 0.25, it's going to be 0.5, 0.10. Last one was a little bit disappointing when there wasn't any change. However, every 0.25 rate move still hits your monthly impacts. So if you look at monthly repayment, if you run the numbers on a $700,000 home loan, that equals about $115 per month. So this small move does make a huge impact on your budget, which is great. When we're looking at lender policy shifts, there are some trends that are sort of changed here. Now, borrowing power is still tight right now. A lot of people are coming to us and stressing about, am I going to be able to borrow enough to buy the property price, buy the properties I'm looking for, because property prices have increased. And what you'll see is that most lenders have actually tightened up their debt to income ratio and their HEM requirements. HEM is how a bank will assess how much you're spending per month to live your lifestyle. And so they've actually made it quite high. and then they've applied a little bit higher of assessment buffers for you. And that's just to protect the market right now. It's not going to loosen anytime yet, but borrowers need stronger incomes or lower debts to qualify. Dom's got something to say here.
Always do. So Carla said two really interesting things: debt to income ratio and HEM, your estimated monthly expenses. So when you apply for a home loan, every bank has a different way of estimating how much money your household would spend on expenses. If you have a high income, $250,000.
It's no rush.
Um,
There's nothing on those days, and obviously just going Monday to Wednesday.
Sorry, we're just going to have to mute someone that's just joined.
Yeah, see if it's going to be anything else on or.
There you are. If you're earning a big income and you're living in Double Bay, they're going to assume, the bank will assume that when you go and do your shopping, you're going to buy Scotch fillet steaks instead of rumps, that you're going to buy premium fruit or, you know, the top choice stuff as opposed to home brand. So this is how the bank assesses based on your income, the size of your household, what your expenses will be. So if they increase the estimated monthly expenses over time, what they're trying to do is they're going to give you less money. You can effectively afford less money to go and get a home loan. The other thing Carla's talking about is the debt to income ratio. By very simply, if the debt to income ratio is 5 times, if your income is 100K, then you're basically maxed at getting $500,000 worth of debt. If they increase the debt to income ratio to 6, you can get $600,000 worth of debt. So that's a very simplistic view. This is why, you know, paying attention to policies has a big impact, because it tells you what the banks want, whether they're willing to give more money, credit's available, or they're tightening up the market.
Absolutely. And that goes into the next point. When we're talking about healthcare professionals specifically, some lenders, well, you actually have the benefit working in healthcare, where some lenders will look at recognizing your overtime. So whilst they are increasing the debt to income ratios and increasing your estimated monthly expenses, they're sort of leaning or allowing for more room in your allowances. They're recognizing your overtime. What that means is when you look at your overtime, most banks will shade it at either 60 or 80%. Whereas when you work in healthcare, they'll take 100% of that because that is income that you're earning and you are spending those extra hours. Another thing is that we notice, especially in healthcare, there will be instances where you might have 1 or 2 jobs happening at the same time or 3 jobs happening at the same time, and lenders are more likely to be receptive to that income and not shaded at the 80% mark, which does give you that more of a borrowing capacity. So this is a small window of opportunity for people who are working in the space, like nurses, doctors, and allied health.
Carla's the head of finance, very technical. What shading means, I'm the dumb one in the team. Shading is discounting or reducing your income. So if you go and work some penalty rates or work over the weekend, you do overtime and you get $100. Some banks will take all of that $100 to use it, meaning it increases your income, your borrowing capacity. Other banks will take 60, 70, 80%. So instead of them saying, hey, your income's gone up by $100, they'll only say your income's gone up by $80. So you can see that by shading income or allowing you to have that full income, it has a big impact. It could be 20% difference in how much you can borrow just based on that one little policy change.
You're right. And then the last one is how the bank is actually scrutinizing your expenses. So in the past, buy now, pay later, like Afterpay, Hum, or the other one, ZipPay, weren't really factored in. Banks would see that as a part of your estimated monthly expenses and living expenses. Whereas now they are looking at it through more of as a different lens. They're treating it like it's credit. So now it's being treated as opposed to an addition to your income or spending that, or a part of your income. They're now seeing it as like a credit card facility. So that changes things for you because there's a higher percentage at which they're going to assess your borrowing capacity. And what you're seeing there is that discretionary spending is now being under the microscope. So what I mean by that is when you're looking at your expenses, some banks will include gifts and your insurances as part of your estimated monthly expenses, whereas other banks will say, well, you don't need to go and buy a gift for your friend to go to their birthday party, and you don't necessarily need this additional health insurance cover. So they'll put that on top of your living expenses, which then can also reduce your borrowing capacity. When you were looking at the private lenders, like Brighton or second tier lenders, they're typically quite good in the respect that they will, they're happy to account for that. Whereas when we're looking at the traditional banks, they quite like to play it safe. And then finally, when we're looking at the key economic trends impacting healthcare workers, what we're seeing is there is a wage pressure versus the cost of living. So healthcare salaries are slowly increasing, but barely keeping up with the pace of CPI and housing costs. So what we're noticing, especially in the healthcare space, is that a lot more people are doing side hustles and locum work where that fills that gap for them. Another thing is that there is an increased demand for healthcare property. What we're seeing is that there's a lot of medical precincts, especially places like the Northern Hills in Sydney. So we'll have Northern Beaches or the North Sydney precinct. Those places are getting really packed. It is really hard to try and find properties in those areas, both in the commercial space and the residential space. And so it's making it a little bit harder for people to get into the market to live closer to work. So people are going further and further out. Don't want to jump into there?
No, that's a good investment tip, actually. So for some of you that are looking to invest in real estate, one of the things that I'd be paying attention to is investments in infrastructure, but one of them specifically is watch the medical precincts. And for the people that are in Victoria, sort of the Heidelberg area, so pay attention to wherever you're living in Australia, where are all the hospitals, where is some infrastructure going in? Those suburbs are growing very well because there's a strong demand, there's a hot demand for that. Healthcare jobs are going up, the pay is increasing at different rates in different states, but pay attention to those areas where there are hospitals.
For sure. And then the last thing that we want to have a look at is the policy tailwind. So what we're noticing is that federal and state incentives are coming in. So we haven't, right now we've got the first home buyer schemes, and that's a national thing, but slowly over the next 6 months, we're going to see more and more details about Help to Buy schemes. So it's easier to get into the market with the government, allowing you to get in with like as small as a 2% deposit if you're a single parent, or a 5% deposit, or having the availability where the government will invest up to 30 or 40% of the property price with you. So you're allowed to go and get something that might be able to afford something in those areas in the high growth precincts. So there's going to be more opportunity for owner occupiers to come into this market, but part of this as well is there is a bit of a longer term on this. So it's not happening immediately. We're going to see some changes with the 5% deposits opening up to the whole market. Now there's no income thresholds applied to that, which is fantastic. That's going to be opening up from January next year. And the pricing thresholds on that, previously in New South Wales, it was $900,000, where they're increasing it to 1.5 million. When we're looking at Victoria, it was previously 750, and that's increasing to 900. So we are getting a little bit more breathing room and accessibility in the market to go and buy things. But there will be more information on these government incentives in the coming months. They're just doing a slow release on them. So we anticipate that coming out about October, November this year. All right.
The 3-part setup. So this part here is really about getting started, getting aligned. A lot of people that we talk to in the hospitals every single day, phone calls that we receive, they just want to know, are they paying too much? The quickest way to find out is literally to reach out. Very broadly, Carla, can you please just kind of cover over what is a competitive rate for an owner-occupied home loan So what are we seeing at the market for your major lenders on a sort of 70 to 80% loan to value ratio?
It's a great question. So when we're looking at between 70 to 80%, we're seeing rates between about 5.59 to about 5.74. So we should be well into the fives by now. 5.5 to 5.75 is what we're looking at. There are a few of you who are lucky where you're getting a little bit lower than that, but it all does depend on your loan to value ratio. And that is how the banks will assess your rate. So when we're looking at healthcare workers specifically, when you do have a higher loan to value ratio, whether it's 90% or 80%, you do get those discounts and you should be paying less. We have clients coming to us all the time and they're still paying well above 6% for their owner occupied home. And I don't know where to start or what to do. So as part of that, have a conversation with us and we'll be able to check if that's the right rate for you and whether your bank could be doing better.
Very quickly, if you're wondering what your loan to value ratio is, what you need to do is take your loan amount. So let's just say your loan amount is $800,000. And then you divide it by what you think your property is worth. Let's just say it's $1 million. Then you'll get a number. You'll probably get 0.8. That's 80% loan to value ratio. Okay. Now, if you are paying too much, if what we've just said sounds like it's too much, then there's two things you can do. As Carla just said, you can reach out to us, easy peasy. Second thing you can do is go back to your bank. Just say, hey, I think I'm paying too much. I spoke to my broker at Healthcare Home Loans. I should be paying 5.5 to 5.7. I'm paying too much. Give me a discharge document, send me to your customer care team, give me a lower rate. If that doesn't work, then come and chat to us. Borrowing power, borrowing capacity.
What's changed and how to increase it?
What's the simplest way for people to increase it, to impact their borrowing power, Carl? If you're just summarize in a couple of quick dot points.
Simple and easy. Have a look at your credit facility. So do you have a credit card? If you have a credit card, per $1,000 that is on there, it's reducing your borrowing capacity by between $6,000 to $8,000, depending on the lender. So that's one massive shift that you can make. Another thing is having a look at your spending. So simple and easy. If you're spending well above your hem, the banks are going to reduce your borrowing capacity. And another easy one is when you work in healthcare, you have the availability of picking up extra shifts, overtime, night shifts, whatever it might be. Those are simple and easy ways for you to be able to increase your borrowing capacity. I'd say when you're looking at your capacity, you have to look at it as a whole. What is comfortable for you? Try and reduce any credit or liabilities that you have out there and see if you can pick up some extra shifts here or there. As simple an easy way to look at it is if you can make an extra $5,000 a year by picking up an extra $100 a fortnight, $200 a fortnight, that does make a huge difference to your borrowing capacity because it could increase it by $20,000 to $30,000. So it's small.
The hot tip there though is they will assess your income, your past 2 pay slips. Marguerite, is that right, Carla?
Yep.
Yes. So if you really want to get excited and do it, you want to hack the system, work hard for the next couple of shifts, couple of pay slips, and then come and see us. Okay. The next part is the property strategy, aligning lending with your long-term goals. This is really about, and we're going to touch more on this shortly. This is really about buying what you can afford as soon as possible. Because I've got an anecdote later in this presentation, and it's showing you that getting started early, using the growth of property to save your deposit, to build equity is much better than waiting 3, 4, 5 years to save more money. You will almost never outsave the growth that you'll get out of a property. So I'll show you that in a minute. We can go to the next slide.
Dom, just real quick. We have clients who have purchased last year who are saying to us, hey, Carla, Dom, Margs, I'm not ready to buy just yet. I want to hold out and save a couple extra $1,000 to get into the market. Now, a couple of these clients who had done that originally, we sort of said, listen, this is the way it's going to work. If you do hold out, the market's going to move. These clients who had actually bought last year are now seeing increases to their property of $150,000, and it would have been much harder to try and save their way there.
So this is an important one. This is exactly what we're talking about a minute ago, spotting the loyalty tax. People are surprised. Just yesterday, I was chatting to a doctor at St. George Hospital, and she said, Dominic, I've been with CBA for 15 years. Her rate was 6.2%. Her loan to value ratio was less than 70%. Very strong income, 2 incomes, no children, no credit cards. Excellent candidate, very, very good candidate. She went back to CBA and said, I would like a discount. And CBA told her to get stuffed. So she refinanced, moved to another bank, and got a rate of 5 point, I think it was 8 with HSBC. Still too high because she didn't follow the Medico policy. So she's talking to us now and trying to get some advice. But the point I'm trying to make here is there are a lot of people that will stay with the same bank because they feel loyal. CBA, Westpac, ANZ, they're different colors for the same thing. They're there to make money, not to be loyal to their customers. Okay? CBA is the biggest business in Australia, not because they give away money, not because they give away discounts, not because they tell you, hey, you're a doctor, you're a nurse, you're an allied health professional, you deserve a discount. Unless you explicitly push, fight, ask for that money, ask for the discount, and ask for what you are entitled to, more often than not, they won't give it to you. So we really do encourage our clients, even people that we're talking to day to day, do as we just said earlier, call your bank, get educated, ask for your discounts. And if you're not getting what you want or what you need, then you should consider refinancing. There's a lot of text on this page. Same income, different strategy. So yeah, I'll let Carl jump into this one. The big thing here is there are different ways to buy property. You can buy it as your own home. You can buy it as an investment. And how you buy the property, how you get the loan, doesn't determine how that loan or home needs to be for the life of the loan. So the way you start isn't the way you finish. So if you buy it as your own home to get a cheaper rate, doesn't mean you can't turn it into investment property later. And if you buy it as an investment property because you want to get a larger loan amount, doesn't mean it needs to stay an investment property, it can become your own home. So over to Carla.
So what we're talking about here is how we've helped some nurses in the past unlock $250,000 more to invest in property. So what you'll see is in the case study, we've got a nurse earning $90,000. That is actually a threshold with some of the banks. They won't give you the discounted interest rates or smaller deposits unless you're earning about that. That's not all banks, but that is some. So what we've done here is we've said nurse who was earning $90,000, the borrowing capacity was between 460 to about 500,000. It's going to look funny, and you're probably going to say, why is there such a big difference between the 460 and 500,000? And that's because different banks will have their different policies, as we were talking to earlier, where they'll include more of borrowing capacity depending on what you're doing for overtime work or based on their policies. So some banks, you might go to Westpac, they'll say, yep, we'll give you 500,000. And you might talk to CBA and they say, look, actually, we can only give you 460. In this scenario, though, we were able to unlock a little bit more money, not a little bit, but a lot more money by including rent. So rent is an interesting thing because if you have, let's just say you're earning additional $500 per week from your property, that's considered as income. So that becomes an annual income, which increases your borrowing capacity. So in this capacity here, when we're looking at an investment, the rental income used has actually boosted her borrowing capacity to up to between 7 to 720,000, which is phenomenal. When we're looking at the different strategy between owner occupied and investment, you've got to think about it in different ways though. Because an owner occupied property has lower rates because it's lower risk, because you're living in there, you're paying it. However, an investment property carries a higher risk because it's a little bit more volatile. It's not necessarily, I mean, in like Queensland and Perth and New South Wales, what we're seeing, it's harder to get into the market, it's harder to rent right now. So it's far and few between to actually find a property to rent. There's not a lot of availability, but sometimes the market changes and it shifts and the banks go, well, your property might not be rented out 100% of the time. There might be a risk. And so they typically charge you a higher interest rate as a result of that. But what you'll notice is that there is a different loan flexibility between the two. So when you go to an investment home loan, it's more likely that a lender is willing to approve you paying an interest-only loan versus a principal and interest loan. A principal and interest loan means you're paying down your principal debt. So if you've got a $460,000 loan, the principal repayments are reducing. Whereas if you have an interest-only loan, that is just staying where it is and you're only paying the interest on it. However, your monthly repayments are much cheaper than paying principal and interest. Another thing that you can have a look at when you're looking at the loan flexibility is the loan type can change. Your life changes, you know, you might move interstate, you might change jobs, you might have a baby, you might move in with your mum. Different situations can come in, and the lucky thing is that we have the availability to change the loan type depending on the strategy. The next thing is also you have the opportunity to move from bank to bank. If this bank's no longer servicing you and not giving you the right amount of money and you need to go get more, or you need to change the specific rate, you have the option of refinancing to something more competitive. What you'll see as well is we get this question time and time again, what tax benefits do I get versus buying my own home versus an investment home loan or buying investment property? Whilst we're not tax agents and we can't give you tax advice, what we can advise is that when you do have an investment property, there are tax benefits applicable, such as the interest that you're paying on the property does become tax deductible. You can claim depreciation on the property, which means the wear and tear of the property, the blinds go terrible, you know, the floor, the carpeting needs to be fixed. All those things become tax deductible. And operating expenses. So if you have someone managing the property, or you have someone going out there to fix the property for a water leak, whatever it might be, all those things become tax efficient for you. So depending on what your long-term goal is, that will then change the strategy that we apply to the home loan. Don't want to weigh in here?
Nope. When the big lesson out of that is, if you're not sure what to do, and you don't know how much you could afford, and you're not 100% clear on your strategy, seek professional help from a broker who can take you through and show you what you're able to do tomorrow, you know, the next year, and then years after that. Show you how your strategy can change. Okay, I'm going to share my screen now. I'll try not to make you all go cross-eyed. Okay, try and stay with me if you can. I'll go nice and slow. Now, I'm pretending that you're a first home buyer living in New South Wales or Sydney. So in Sydney, as a first home, in New South Wales, a first home buyer, you can go and spend up to $800,000 and you don't need to pay stamp duty, okay? You can also get into the market with a 5% deposit. So let's assume you go and buy a $800,000 property. You need to pay some solicitor's fees, some reports and things. So you're going to put in $5,000 in fees. So what that means is total, you need to put in $40,000 plus an additional $5,000. So your total deposit that you require is $45K. Let's just stay up here. Now, if we're just going to look at this top line, historically speaking, property prices across Australia have on average, grown at about 6%, okay? So if this $800,000 property grows by about 6%, compounding, so year after year it grows 6% on average, after 5 years, this property where you put in $45,000 would be worth about $1,071,000. Okay. Now, the equity, the amount of cash that you have inside of that deal is this line here. You'd have $363,500. So you can see by putting in $45,000, buying something that's within your means will enable you to have more than $300,000 in equity in price growth by getting into the market sooner. You know, a lot of people, 5 years might be extreme, but let's just have a look at year 3. After 3 years, 45K will enable you with the right property to have over $200,000 in equity. Now, many people will actually delay getting into the market over 1, 2, and 3 years to save an additional 10, 20, 30, 40K. So the big point that I want to make to all of you watching is use the property market to your advantage, use the first home buyer incentives to your advantage, use your Medico policies and benefits to your advantage. Get into the market as soon as you can with a little bit of help and guidance. Take advantage. Don't pay stamp duty. If you don't have to. Don't pay your lender's mortgage insurance if you don't have to. Just get in and use the time in the market and a good asset for that price growth, which enables you to have built-in equity. I will stop sharing. Keep on presenting. Oh, it's actually back to me.
On you go. Now, the monthly housing chart.
Yes. So for all of you, I'm a bit of a property nerd. I love real estate. Been doing this for 17 years. For any of you that are interested in real estate, there's one website you can write down. It's RP Data. It is Cotality. They've just rebranded. They are the premier #1 brand for property data. And this is just, they give you data segmented based on the country, the state, regional, cities, how property prices are changing, growing, how much rent is happening. So the big update is over the past 3 months, national values have grown by 1.4%. So to put that into context, if you've got a $700,000 property over the past 3 months, that property has grown by 1.4 times 0.0014. You've made about $10,000, so not bad. It looks like the property market over the past 12 months across the nation has grown by 3.4%. So that's an additional sort of $30,000 to $50,000 in your pocket over the past 12 months. Carla, can we change the slide? This here, you can see the big standout growth driver of the country has been Darwin. It's grown by 4.9%. That's Darwin City. Behind that, you've had Brisbane, Perth, and Canberra's finally starting to grow just a little bit. But largely, what we're seeing across the country, it looks like the property market is responding positively to the decreases in interest rates. So we've seen about 3 rate decreases. And what we've historically seen is as interest rates go down, people can afford to spend more. So what they do is spend more. And then that puts upward pressure on property prices. So just think about this. As rates go down, property prices typically go up. Now, for all of you that are sitting on the fence, thinking about getting in the property market, getting splinters up your bum, they are talking about further rate decreases and anticipating further price increases in the property market. So it is better to get into the property market sooner rather than later. Carla, we can continue. Okay, 12-month price changes. The big winners have been regional Western Australia, regional South Australia, then regional Queensland at 11.9, 11.6, and 7.9%. They're big, big price increases. Behind those markets, we've seen Adelaide, Brisbane, Perth, and Darwin grow. The capital cities are growing very well as well. So 6, 7, and 8% are strong price growths. The reason why we're seeing the regional markets perform well and we're seeing the other states, not Sydney, perform so well is people have been moving towards price sensitive properties, cheaper markets. A lot of investors have been stepping into the market, coming out of areas they can't afford, or pulling out equity out of their own home and putting that money in other states. So that's something to keep mindful of. I think this trend will continue. We will see more people investing in cheaper markets or cheaper price point stock. Next. Okay, what to do next? What to do next? What you could do next is you could book a free lending setup call. These are discovery calls. You'll chat to myself, you'll chat to Georgia, one of the other team members. You don't get to talk to Carla or Marguerite until you do a loan solution meeting. But the first step is having a conversation. That's the best way to get started. You can simply get your phone, scan that QR code and get started. You can click on our website, book a meeting at a time that suits you, or you can leave an inquiry and we'll call you back. You can log online. There are first home buyer toolkits. If you've got a friend or a colleague that is interested in buying real estate, getting a refinance, looking at doing something with their loans, it's $100 for you and them. Refer a friend. It's been really good talking to you all, talking at you all. Thank you, Marguerite. Thank you, everyone here. Carl's, you got any final words?
No, if you've got any questions, reach out to us, guys. We're more than happy to help.